So today I'm going to tell you about an awesome strategy that's helping buyers, sellers, and realtors alike in this challenging real estate and mortgage market that we're in today. It's called a temporary buy down strategy. And here's how it works. Here's the concept. It's for a seller, for a home, an apartment that's not moving, right? Not getting a lot of activity, not getting a lot of people to the open house. Now the seller and the listing agent are sort of talking and thinking, well, what do I do? Do I lower the price? How do I get buyers to come to my home and give offers? Well, here's the strategy. You give a temporary buy down to the interest rate. The seller gives a concession or a credit to the buyer to buy down the rate for the first few years of the mortgage. Again, they do that to entice the buyer, to help the buyer, to bring the buyer to their home and make the buyer feel better. And of course, the buyer's going to love that, because who wouldn't want to pay a lower than prevailing or current rate interest today and tomorrow and perhaps for the next 3 years? We believe, or experts are saying, and myself included and my co-workers, we believe that in the next few years, hopefully within the next year, we're going to see interest rates go down. Why they've been going up so high is because of inflation, right? And other various things that are happening in the world today, but mostly because of inflation, right? And what the Fed wants to do, the Federal Reserve, is bring inflation, calm it down. Interest rates follow inflation. So if inflation comes down within the next number of months, within the next year, we'll see rates come down. So the temporary buy down is just that. It's temporary so that when these wonderful rates come back, and we do believe they will, then you refinance out of your current loan with these higher interest rate loans that are happening today, and you refinance out and you get yourself a lower interest rate. So the concept, 3-2-1. We have cross country. I work for cross country, and they have 4 different buy downs. They have a 3-2-1, a 2-1, a 1-1, and a 1-0. Again, 3-2-1, 2-1, 1-1, and 1-0. What does that mean? Well, 3% lower than the current interest rate in the first year, 2% lower than the current interest rate in the second year, and 1% lower than the current interest rate in the third year. And then after that, it goes back to the prevailing or the current rate that we're current in today. But again, the idea is to refinance out of the loan before that happens. And then the 2-1, again, 2% less than the first year, and so on and so forth. You could figure out the other ones, the 1-1 and the 1-0. Well, this calculator that I created goes through all the scenarios with showing you the numbers, right? And this, I love this calculator because it's very helpful for buyers, sellers, and realtors alike to see how this whole thing plays out. And that's what I'm going to show you right now, okay? So let's go to our first example, which is, I'm going to go to the 3-2-1, okay? And I'm going to break down the whole calculator for you so you understand this. And if you have any questions, by the way, you can give me a call, send me a text, shoot me an email. Okay, so here's how it works. Everything in blue is a user-entered field. User-entered field, okay? So first field is our purchase price, right? Let's say $800,000 in this example. Actually, you know what? I'm going to drop it. I'm going to drop it. I just feel like dropping it to $700,000. Okay, $700,000, 20% down. The loan amount would be $560,000. Down payment is $140,000. 30-year amortization, 30-year term. Let's use 7% as the prevailing or current rate today. Again, 3-2-1. Property taxes for the year, $6,000. Homeowners insurance for the year, $1,200. Do note, this calculator does not take into consideration mortgage insurance. Mortgage insurance is something, as many of you know, that mortgage insurance, if you put down less than 20% in the United States, you have to pay mortgage insurance. This calculator doesn't incorporate that. Okay, so 3-2-1, 7% interest rate. So again, what did I say? 3% less than 7 is 4% in the first year, right? And in the second year, it's 2% less than the 7, which is 5%. And in the third year, it's 1% less than the 7, which is 6%. And then after that, all the years thereafter, it goes back to the current rate of today. In this example, 7% forward, ongoing, okay? So now I give you the mortgage payment, okay, also known as PITI, principal, interest, taxes, and insurance, PITI, okay? So property, principal and interest, tax and insurance. So your principal and interest payment on a $560,000 loan at 30 years is going to be $26.74 per month. $26.74 per month. That's in the first year at 4%. At 5%, it's going to be $3,006 per month. At the third year at 6%, it's going to be $33.57. Okay, and then in the fourth year, $37.26. Okay, then of course I drop in my property tax, stays constant at $500 a month, and my homeowner's insurance at $100 a month, and our full mortgage payment you can see down here. I'm not going to go through tell you every one of these numbers, but you can see it down here. Okay, here's the big thing. Here's the kicker. The difference. Let's talk about the difference between the first year's mortgage payment and what it would be at the prevailing rate of 7%. It would be $1,052 a month. $1,052 a month for 12 months. That's $12,626. That's a tremendous savings to the buyer, right? Could you imagine getting $1,000 off your rent or your mortgage payment today? It's a great thing, right? And let's look at the next year at 5% interest, okay? You've got a $719 per month savings, and that over 12 months is $8,600. And let's look at the third year, $368 a month savings between the principal and interest of the year 3 and the prevailing or current rate. Multiply that by 12, that's $4,400. Add these three up, and that's a $25,000 savings for the first 3 years of the mortgage. Now, this has to be paid, right? So this is what the concession would be, or the credit would be by the seller, right? So the seller gives this as a credit or a concession to the buyer. Concept is you refinance out before you get to the end of the, you get to the current or the prevailing rate. Now, if you have money left over, if there's money left over, let's say you do the 3-2-1 and you've refinanced in the second year. Now you've got credit that was there to pay down for that third year. Well, that credit could go towards a principal buy down, right? That credit buys down your principal, right? This is really cool. So I think it's pretty clear how much this can help everybody, right? Realtors, the sellers, the buyers, make everybody happy, and get more deals done. So again, if you have any questions, you email me, text me, give me a call, and more videos to come. Thank you so much for watching. We'll talk to you soon.